the financial types in these movies behave themselves very differently. In Trading Places, it's very much like an old money kind of club. They go to the country club and they're playing tennis, and their barbershop quartet from Harvard is like singing songs. The butler stands here and says this and hands you that at the right time. And then compare that to Boiler Room. You can compare that to Big Short. You can compare it to The Wolf of Wall Street. It's much more just kind of debauchery, right? Like sex and drugs all over the place. They have no pretense of like, we are respectable people that are shepherding our institutions. My professor, Bill Black, has got a paper that's kind of on this topic, which is like, it helps if you can get a really toxic culture in the business place. The workers competing against each other, really cutthroat, racism, sexism, like whatever else. Now you have your workers that are like not really thinking of people as people, that are thinking of them as marks to be taken advantage of. And these kinds of schemes, they need that kind of culture. And so they create it.
This is the MMT Podcast with Patricia and Christian Riley. Hi, I'm Christian Riley, and welcome to the Modern Monetary Theory Podcast. You can find us on Twitter at MMT Podcast, and you can support the show by going to patreon.com/MMT Podcast. If this is your first time hearing about MMT, you might want to listen to our first 3 episodes for an introduction, which I've linked to in the show notes, along with some other things that relate to this particular episode. And as ever, I've linked to where you can support this podcast financially via patreon.com/MMT Podcast. Support starts at $1 a month or £1 a month or whatever the equivalent is wherever you live. We're 100% listener funded. Your financial support really helps keep the show going, and your support in other ways, whether it's by recommending us to other people or just by listening and spreading the word about this stuff, really helps too. A big thank you to all of our supporters so far, and thanks as ever for the time you put into understanding MMT. Let's dive in. Welcome one and all to the MMT Podcast. I'm Christian Riley.
And I'm Patricia Pino.
And we are delighted to welcome back to the show our friend, MMT scholar, writer and teacher, and now Dr. Sam Levey. Hi, Sam.
Hi, thanks for having me.
So just before we dive in, Sam, congratulations on recently defending your PhD dissertation on mobilization theory.
Thank you. Thank you very much.
To the listeners, I'll just say that all our previous episodes with you, Sam, have all been to some extent about your really valuable work in that area. And I think they've been some of the best episodes we've ever made. So I'll link to all of those episodes in the show notes for this episode. But now on to business, and there's no business like show business. And so in this episode, we're going to be talking about some cinematic depictions of the world of finance and comparing them to the real life situations they're supposed to be depicting. Because for the vast majority of us who aren't stockbrokers or floor traders, what we know about this world comes from media and pop culture. And to outsiders, being one of these people seems to consist of wearing a suit, yelling at people, and developing a drug addiction to cope with the emptiness of it all. So in many ways, a typical job. But in case there's more to it than that, to kick things off, I can't think of a more fun depiction of the world of finance than the 1983 film Trading Places with Eddie Murphy, Jamie Lee Curtis, and Dan Aykroyd. And there will be spoilers in this episode, so if you've never seen Trading Places, which is 40 years old this year, what have you been doing with your life? So onto the film. The plot of Trading Places is a cover version of Mark Twain's The Prince and the Pauper. So 2 very different people swap lives, and in Trading Places, those 2 people are a very well-to-do, affluent, successful commodities broker, Lewis Winthorpe, who's played by Dan Aykroyd, and another enterprising individual of a very different variety called Billy Ray Valentine, who's played by Eddie Murphy. And so to set this up, Sam, what does a commodities broker do?
Okay, well, maybe before I answer that, I should probably preface with, I think you got the wrong guy for this episode, right? I'm an economist, so I get to like sit at my desk and think, or talk to people who are on the inside. So like I do have a couple of friends on the inside, and I regularly ask them, what are things like? So I'm developing a sense of it that way. But, I'm going to give you my perspective as an economics guy. Okay, so what is a commodities broker? So what they do is that they sell goods and services, right? And specifically standardized commodities in large amounts, right? So like we're not talking about the orange juice that you get in a carton at the grocery store, they're talking about like huge packages in large shipments, right? By the truckful. And there's a whole bunch of different commodities that they talk about in the movie that they sell. Frozen orange juice concentrate was a major one. They talked about coffee, gold, a few others, wheat, corn, stuff like that. So this is like the supply chain a few steps before it gets to the retail stage where you and I would buy. Like I'll tell my students, there's like the production stage where the goods and services get produced somewhere. So maybe a farm grows corn or something like that, right? And then there's like this distribution stage, okay, where like the goods make it from the farm to this wholesale stage where they're traded in large amounts, right? And then from the wholesale stage, they make it to the retail stage where they're traded in much smaller amounts, like you buying a carton of orange juice. So this is kind of the financial end of the commodities world, right? Like I have a friend who used to work at a place that traded propane. And so they would trade like the financial end of propane. They'd also do stuff on the real end of propane. So they'd help with the logistics and make sure it gets shipped and trucked to where it needs to go and, on the right trains at the right time and stuff like that. But then there's the financial end. So it's arranging for people who are going to buy and sell and making sure that buyers and sellers can meet. Kind of like a big picture issue here is like, how do buyers and sellers find each other? And for most retail people, this is often kind of a solved problem. You know where the grocery store is, you just go there. But, when it wasn't a solved problem, or for goods and services where it's not a solved problem, we need a lot of machinery to do this. And that's one of the things that these brokers do, is get buyers and sellers to meet.
To be honest, I think a lot of the people in finance and doing trading in particular is a very stressful job. From what I've heard and from what I've heard from people who told me that they do this for a living, is one of the most stressful jobs you can do. And of course, if you don't make money for a certain amount of time, then your job is on the line. And when you do make money, I guess you run the risk of getting a bit like the main character in the movie.
So for the listeners, I got assigned some homework before this recording to watch a handful of movies about finance and Wall Street and stuff. And this movie was one of the older ones. I think this movie came out in 1983. And so it's depicting the world of finance in the 70s. Whereas if you watch like The Wolf of Wall Street or something like that, that movie came out in 2013, I believe. And it's depicting finance in the 90s. And you do get a big shift. And so, Patricia, you're talking about like, it's a very stressful job. It's famously stressful. They got the traders working 80-hour weeks. And they're doing it because they want to get rich.
Was the hours better in the 80s?
Yeah, so there has been a shift over time, especially from the 70s to the 90s and into the 2000s. There really was a shift. And there's a couple of factors that I would attribute that to. One factor is the shift from a kind of compensation model where the executives are getting paid salaries to a model where the executives are getting paid in stock options, and the lower level employees too, getting paid in stock options. And so you get this whole big kerfuffle that I believe begins in the 70s and into the 80s about shareholder primacy. So one big proponent of this idea is Milton Friedman, who says that the singular job of a corporation is to make money for its shareholders and nothing else. Like what a corporation should do is any legal thing that it can do to create profit and make money for its shareholders. Before that time, there was actually a kind of widespread different idea about how corporations should function. There was a widespread idea that, well, corporations represent all these different constituencies. There's the workers and, of course, the shareholders, but the bondholders, the customers, the community. And it's the job of the corporate board of governors to balance those interests. And there really was more of a sense that corporations are citizens of the country and they have some duties to promote the general well-being while, of course, making money. And that goes out the window starting in the 1970s. The idea is that the only job that the corporation has is to make money for its shareholders. And part of the way to do that, the thinking becomes, is, well, we've been paying these managers and also some of the lower level workers in salaries. They just make some amount of money regardless of how good of a job they do. What we should be doing instead is giving them incentive to run the company in a way that's going to make more money for the shareholders. So that's something like stock options, right? If we pay the CEO in stock options, then they do better when the stock price is higher. And so now we've aligned the incentives between the CEO and the shareholders. And so you get this wave of, it's called modern executive compensation, change in the way that executives are compensated to try to align their incentives with that of shareholders. And so now the CEOs are making more money themselves personally when the workers work more hours, right? Whereas before it was a little more indirect. Maybe the company does better, and so then everybody can kind of have a raise. But now it's like if you directly put in another hour and maximize the value of our firm, then the CEO will get a bigger bonus or something like that, right? And so there is a change in the institutional structure, which I would say leads to a change in the culture. And so you do get a shift.
I think, Sam, you're mentioning Milton Friedman. Is it that essay on the social responsibility of businesses to increase its profits?
Yep, that's the one.
And I was going to use the word ruthless before when describing the trading environment, but I didn't use it because I didn't think it was quite accurate. But there is a going with the Milton Friedman theme and this kind of ideals, right? These are things that people are in this industry and in corporate businesses generally, they are kind of taught to embrace as an aspirational thing. This idea that you are better off acting on your head than on your instinct or emotions or empathy or anything like that. And there is in trading this is going back to uni, and they teach you some basic principles of how to act, is that basically you should not really be reacting to what they consider fear or anxiety. If you're feeling anxiety, either because you've put too much money on something and you're not comfortable with it, then that undermines your performance, right? So you should have a cool head at all times. And I feel that goes along very well with the whole Milton Friedman theme, because basically people in these institutions, they're sort of told to act as if they were robots, effectively. Do you see what I'm getting at here?
Yeah, it's funny. We're talking about executive compensation here. In the film Trading Places, when Eddie Murphy's being trained, I'll call it trained in inverted commas, as a commodities broker, he's told by his bosses that the firm will always earn a fee, whether the positions they take earn or lose money. So when you watch the film, it seems like it's taking a swipe at capitalism, but really what they're doing is saying, oh no, this type of financialized capitalism where you can't lose, that's not capitalism, if you know what I mean.
Well, yeah, I wouldn't say I read the film as anti-capitalist too much.
No, I just mean that moment in the film that they're laughing at the idea that, hey, it doesn't matter whether our clients make or lose money, we'll make money, ha ha ha. And that they're kind of a classic sort of top hat wearing, mustache twizzling baddies at that point.
And Eddie Murphy says something like, sounds like you guys are a bunch of regular bookies.
Yeah, exactly, yeah.
Like this is gambling, this isn't serving a useful purpose.
Yeah, and so the meat of the film that I wanted to get to that is going to require a bit of setting up, so apologies for this. The ending of Trading Places, it's wonderful and unique, but to sketch out the plot and how they get there is Eddie Murphy's character, Billy Ray Valentine. And by the way, Billy Ray Valentine is referred to in the film's publicity as a street hustler, right? And I find that a bit unfair because it looks to me as if he's actually a homeless person at the beginning of the film. All he's trying to do is make a living by pretending to be a war veteran and asking for spare change. And I'd say in 2023, that's called inflating one's resume. And so far, no one's been prosecuted for it. I mean, I'd say ask George Santos, but we don't even know if that's his real name. So back to the film, this entrepreneur, Billy Ray Valentine, literally bumps into the commodities hustler, Lewis Winthorpe. Through a series of misadventures, they become the subjects of a bet between Winthorpe's extremely rich bosses, Mortimer and Randolph Duke. Randolph believes that even a very disadvantaged person like Billy Ray Valentine, given the same opportunities, can thrive just as well as or even better than a very privileged person like Lewis Winthorpe. And he's at odds with his brother Mortimer, who thinks that greatness is something that can't be taught. It's in the breeding, as he puts it, it's in the blood. And so to settle the nature-nurture debate, they cause Lewis to lose his job, and they do it in a way that covers him in shame and scandal. And so his social circle turn against him, and he loses not just his wealth and status, but also any opportunity to change his wealth and status by calling in favors. And then they slot Billy Ray Valentine into Winthorpe's old job and give him the big salary, the fancy home, and the personal butler, and they bet on whether Billy Ray will succeed or fail. Now he's been given the same privileges and opportunities as Winthorpe. And eventually together, Billy Ray and Lewis figure out they've been turned into human guinea pigs for a bet. And to get back at Mortimer and Randolph, they decide to ruin them financially. So what I really wanted to get to is let's have a look at how they do that. And I thought to set us up for this, Sam, we probably need to understand short selling. Are you comfortable with doing that?
Sure.
Okay, tell us about it.
Okay, so whenever you talk about some asset, you'll hear these two terms, long and short, right? Somebody is long if they benefit when the price goes up, and somebody is short if they benefit when the price goes down. And so you can basically think of it as taking a position, making a bet, right? I want to go long this asset means I think the price is going to go up. I would like to take on some exposure whereby I will profit if its price goes up. Same, the reverse on the other side. If someone says, I want to go short an asset, that means they think the price is going to go down. You want to take on some exposure whereby you will profit if the price goes down. And so the way this is done with stocks is that, or at least the simplest way we think about it, is that to go long stocks, you just buy it, right? You buy a share of stock. Maybe let's say you buy a share of stock at $10 and now you own it. And then if the price later goes up to $20, then you sell it at $20. And you've made your $10 profit, 20 minus 10. And so you went long and you profited when the price went up. And what you do there is you buy low and then you sell high. That's the famous dictum from the world of finance. Buy low, sell high. You don't want to do the opposite because then you'll be losing money. When you go short selling, you basically do those two steps, but in reverse. You sell first and then buy later. And the way you sell something you don't have is you borrow it from somebody else, right? So you borrow a share of stock and then you sell it at its current price. So maybe the current price is $20. You borrow a share, you sell it at $20. So now you've just taken in $20. And then you've borrowed the share of stock, so you're going to have to return it. So sometime later, you buy it back. And let's suppose the price went down. So you buy it back at 15, maybe. So you buy the share back, you pay $15, you return the share to its original owner. And now you've just made $5 because you got the 20 and you paid back the 15. So you've walked away with your $5 profit. And so you benefited when the price went down. You were short the asset. It started at 20, went to 15. You made a $5 profit because of that. So that's what they do. That's what Winthorpe and Valentine do. They sell high. And then when the price goes down, they buy low.
Patricia, in your training, did they teach you much about shorting, or is it a common thing?
Well, what they told us is if somebody has to take the other side of the bet that you're making. So if somebody bets long, then somebody else has to be betting short.
But how does that work? Because it seems to me like nobody has to go short, and the people with long positions still have their long positions.
You kind of have to distinguish between short selling in this mechanism I'm talking about, like borrowing a stock and selling it and then buying it back to cover your short, versus just the general broader idea of being short, meaning I expect this price is going to go down and I benefit from that. So maybe you could think of it as kind of being virtually short. If you just sell an asset and then the asset price goes down, you are kind of indirectly benefiting from that in the sense that you're not selling it at a lower price now, right? So let's say you got a house that you own maybe, and you're trying to decide, should I sell it now or should I sell it in 6 months? And of course, there's all your personal life factors that go into this, but there's also the financial angle. What is the price now? And what do I think the price is going to be in 6 months? If I think the price is going to be a lot higher in 6 months, then I should hold the house and sell it in 6 months. I'll make more money. On the other hand, if I think the price is going to be lower in 6 months, then I should sell it now rather than wait. And so it's if somebody else, maybe a house is a bad example because there's too much personal use. Let's say stocks, okay, because it's really more purely financial. If I think that the price is going to be lower in 6 months, I'm going to sell it now and I own it. I'm going to sell it now. And somebody who's buying it from me, maybe the reason they're buying it is because they think the price is going to be higher in 6 months. And if it were the reverse, if I thought that the price was going to be higher in 6 months, I just wouldn't sell it now. And then the person who wants to buy it, they'd have to find somebody else who is on the other side of that. So that's kind of what we mean by for every short, there is a long. It's kind of just a shorthand way of saying that this is a zero-sum game, that somebody's going to benefit from the price moving one way or the other, and it can't be both of you. But that doesn't necessarily mean that people are that doesn't necessarily mean that if I buy a share, there's somebody else on the other side who is borrowing that share to sell for me. That's not necessarily the case.
So now we understand that pretty much what happens in the film is insider trading based on a leaked crop report. Basically, Lewis and Billy Ray find out that the Duke brothers have a shady operative who has somehow stolen a crop report that's not supposed to go public for a few weeks. And the crop report says that the orange crop is going to be unaffected by the unseasonable bad weather that they've had. And so there's going to be plenty of oranges around. And they steal that and they change the report to say that actually, no, it's going to be affected very negatively. The crop is going to be affected very negatively by the bad weather. And so the Duke brothers think that the price of frozen concentrated orange juice futures is going to go up, if I've got it right. And we know, or our heroes in the film know, that actually, no, the price of oranges is going to be unaffected by this exogenous factor, the weather. So when Billy Ray and Lewis get to the trading floor of the New York Mercantile Exchange, it's important to understand those traders on the floor, they're buying and selling futures in frozen concentrated orange juice rather than orange juice itself. Now, what does that mean?
So that just means instead of like you sign the contract and here's your orange juice, it means you sign the contract and we'll give you the orange juice in 3 months or 6 months or however much time in the future the contract is for.
Uh-huh. And when you were describing short selling a few beats ago, you mentioned that the short seller borrows the shares, sells them at what they think is going to be a high price, and then later on buys them back. Now, do they have to set a date on when they buy the shares back, when they have to, I guess, close out their position?
Yeah, so this is really interesting, actually. Like the way this works in the stock market with modern brokerages is you as the person short selling don't actually have to worry about any of that at all. It gets handled behind the scenes for you. And somebody else who is lending you their shares technically might not even know that this is happening. Like the brokerage just handles all this kind of on a behind the scenes sort of basis. That tends to be how things work with organized exchanges. It makes it just much easier for people to take short or long positions. So like, I don't know if you've ever traded stocks like on just your own account, maybe for fun, or maybe you've become a wide-eyed speculator. I don't know. But, you know, there's like on the online brokerage, there's like a checkbox you tick, like do you want to go short or long, basically.
I think part of the reason why short selling is controversial is because, well, in trading in general tends to be pro-cyclical, right? And you get big bubbles, and when the price goes up, that sort of reassures all the people that the price is going to carry on going up, and then you get the bubble, and then at some point it bursts, and that is quite disruptive. But when it happens the other way around as well, in the financial crisis, when everybody's just desperate to sell, and you can actually ruin companies or ruin businesses that would otherwise had been okay. So you can sort of, by betting against something, you can in itself can cause that thing to crash. So that's the concerning thing.
That brings us to, I guess, what gets called the bandwagon effect. And the scene at the end of Trading Places on the trading floor, I would say, is an illustration of this bandwagon effect. Can you say what that is?
Yeah, so the post-Keynesians love to talk about uncertainty. We live in a world of fundamental uncertainty. You don't know what's going to happen next. You can't even calculate a risk or expected value or probability distribution or something like that. You just don't know. And so what do? If you live in this big, complicated world where there's a lot of uncertainty, then you have to find ways to still live your life and take action and trade your securities or whatever. And one of these rules of thumb you might come up with is follow what everybody else is doing. Because there's some, it's not totally irrational. There's logic there. Like maybe people know something that I don't know, right? And so you see in Trading Places, as soon as the Dukes start trying to corner the orange juice market.
And I'll just jump in and remind, okay, because they think the price is going to go up because oranges are going to be scarce. So they tell their, I guess, trader on the floor, look, buy as many futures as you can get your hands on. And don't worry about it if the price starts to go up. Just keep buying, right?
Yeah, they think that the weather's going to be bad. The price of orange juice is going to be high as a result of this. So they're trying to go long orange juice, buy as much as we can, and then we'll own orange juice. And then when the price goes up, we can sell it. And maybe they're not talking about selling the juice. Maybe they're talking about selling the futures contracts, but it's basically the same thing. They expect the price to go up. So they're trying to get as much as they can, and they don't care if that drives the price up. In fact, that's good for them. And then the other traders see this, and they cut to another trader who says like, hey, they're trying to corner the market. They must know something we don't know. Let's get in on it. So let's start buying as well, right? And so this is the bandwagon effect, is doing what everybody else is doing. Another related term you'll hear is like momentum trading, which is like if some stock or some asset is moving up in price very quickly, then maybe it's going to keep moving up in price. So you should buy it now too, And then when it goes up in price later, you'll be able to sell it, right? Or also the reverse. If some asset is moving down in price very quickly, then maybe you conclude it's going to keep moving down in price, so you should sell it now too, so that you don't lose out when it's at a lower price later.
When we spoke to John T. Harvey, I said, this is kind of like that phrase, nobody got fired for buying IBM. If you buy IBM, it's supposed to be a safe stock. So if it goes down, they'll be like, well, who could blame you? It was IBM, right?
Yeah. Haynes has a great... Oh, go ahead.
Yeah, well, he responded with, I think, what you were about to say, which is, look, it's better to fail conventionally than succeed unconventionally.
Yeah, that's exactly right. Yeah, that's a Keynes quote. Yep.
Yeah, good stuff, Keynes. Still got it.
He also said markets can remain irrational longer than traders can, or something like that.
Longer than you can remain solvent, I think.
Yeah, that's it.
Yeah. Yeah, exactly. Yeah. He knew a few things, didn't he, that guy?
Yeah, there's one more good one that's relevant here where he says, like, as long as the speculation in the financial markets is just a side product of capitalism, then it's fine. But once it becomes the main show, then, the development of the economy is likely to be poorly done.
Again, which is, I think that's what all these films that we've been watching lately about the finance sector, it's kind of centered around that, isn't it? It's kind of trying to sort of get people to look at this development that's happened in capitalism called financialized capital, basically.
There's a lot of kind of traditional values, maybe Protestant values that you hit up against here, right? The value of a hard day's work, the value of making something with your hands. There's a line where Jamie Lee Curtis says to Dan Aykroyd, Dan Aykroyd's the trader guy, and Jamie says soft hands, you've never worked a day in your life, right? And here's a guy who's been running a big financial firm for years.
Yeah.
So it comes up against that stuff. And so there really is a long-running historical debate about how much finance do we need? When is it too much? Which parts of finance are useful and which parts are just gambling? And also then if we think of it's just gambling, is it moral to have this gambling or is it immoral? I don't have answers to those. I mean, I have opinions, but...
So in the film, the Duke brothers start to corner the frozen concentrated orange juice futures market. And at some point when the price gets up quite high, Dan Aykroyd yells, and lots of people can't make it out, but I'm told the quote is, sell 30 April at 142. And so the idea is he's selling 30 futures contracts at a price of 142 per pound. So then everybody turns around and buys from them.
Basically, everyone was trying to buy, the price was going up, and then suddenly they say, hey, we're going to sell a lot. And at that point, the bandwagon kind of flips a bit. Right before it was oh, the Dukes must know something. They're trying to buy. We should buy too. And now it's oh, what do these guys know? They're trying to sell. Maybe we should try to sell too. And so suddenly there's mass confusion, right? Before it was pretty clear. Everyone's trying to buy. Now it's a little more confused and they sell a lot and they drive the price down. I was trying to look at the board. They got the ticker board. And I was trying to look at it and see what the price was before they said that. And I think it was 139. So they actually set a price that was a little bit above what the going price or what the last transaction price had been. But I think what's key there is really just that they're selling a large amount. And they're selling to a crowd that wants to buy, but they're selling enough to bring the price down. And of course, remember, they don't have this, right? They don't own this orange juice. They're going to cover this short later, but they're selling a large amount.
Okay, so they get a lot of takers for this deal, and then everything stops on the trading floor for the crop report, and the crop report says, actually, oranges are not going to be very rare in April. And then all of a sudden, the price really starts plummeting, and they've already sold a lot of futures. And so what happens next?
Yeah, so once the crop report comes out, now there's new information, right, that informs what the price should be. The price goes down a bunch. And as the price is going down, a lot of the other traders who have bought high, now they want to sell because they realize the price is going to drop a lot. They're going to lose a lot of money. They're trying to sell as quick as they can, which of course drives the price down, right? So this is a self-reinforcing type of thing. And once the price gets low enough, then Winthorpe and Valentine start buying. And the reason they have to buy is to cover those shorts, right? They were selling positions they didn't own. Now they have to buy them so they can actually deliver those.
And it gets down to 72, then 64, then 46. It goes right down. And at that point, the trick is they buy from everybody except the Duke's trader, because they want them to be saddled with these really expensive frozen concentrated orange juice futures, right?
Yeah. So all the other traders, the term you might hear is overbought. There's a real big long position. They have purchased these futures, but Winthorpe and Valentine are selling. And so the people with the excess long position that need to get out of it need to sell to somebody. That's Winthorpe and Valentine, right? They start buying when the price goes lower. And you're right, they just don't pay attention to the Duke's trader. They're trying to make sure that they can't unload those contracts. They get stuck with them. And so Winthorpe and Valentine make a ton of money because they sold at a very high price at the beginning, and then they buy at a much lower price. I think the price goes down to like 39 or something like that. So they're selling their first contracts at 142 and buying at 39. So they're making a huge, huge profit on this. And then there's another aspect we can get into as well, which is about margin and leverage. But they make an enormous profit on this. And, it's enough in the epilogue scene to send them to an island, and they're sipping drinks, and they got their own boat, and the butler has his own butler. So they make a killing. And the Dukes get saddled with this position that they couldn't sell. I mean, they could try to sell it to other traders, but the price has dropped a lot. It's much lower now than when they bought it. They're making a huge loss.
And so at the very end of the film, as you say, the baddies, the Dukes, get their comeuppance, and they face what's known as a margin call. Patricia, what's a margin call?
So when you place a bet, sometimes, you don't put the whole money in, you put a proportion of the money in. And if your position changes either in the positive or in the negative too much, then they may ask you to increase that margin that you've put down.
Yeah. So, it's really about leverage, which is just another way of saying borrowing money to take some position. So like probably the one that people are most familiar with here is like home owning. When you buy a home, it's pretty typical. You put some down payment and then you borrow the money for the rest of the purchase price of the home. And so that's you taking on leverage. You're borrowing in order to purchase some asset. And what that means is, though, that you can take a position. You can think of being long your house. You take a position in an asset, and the position is much larger than the actual money you put up front, right? Maybe you put down $30,000 and you buy a house that's $200,000. So you're long this $200,000 asset, but you only actually put in $30,000. And that's dangerous. Leverage is really, really dangerous.
Would it be a bit like, say, if you purchased a house at $100,000 and suddenly the price changed and the house was only worth $90,000 and you had only put a $5,000 deposit? If the bank, say, was asking you, can you please give the bank now another $5,000 to cover what the bank would not recover if you were to default on your loan?
Yeah. I mean, at least in the US, banks don't do that for home loans, but that's right. It's like you don't have enough of your own capital. So the example you're saying, so maybe you put down $5,000 and you buy a $100,000 house. If you buy the $100,000 house, you could always sell the house. You get $100,000. You repay the loan, which was only $95,000. And now you have $5,000. You get your money back. If the value of the house drops, maybe if it drops to 95, okay, now you sell your house for 95. You use that 95 to repay the loan. And now you've lost everything you started with. You've lost your capital, your down payment, your initial deposit. But the value of the house could fall more than that. Maybe it does fall to 90. You sell the house, you get 90. You don't even have enough to pay back the loan, right? The loan was 95. You only have 90. You pay them the 90 and you still owe them $5,000 that you don't have anymore. And so this is why leverage is dangerous. You can lose more than you put in. And so the broker or whoever's lending to you, whoever's allowing you to take on this leverage, to protect themselves, they require you to have margin of some kind. So it's an account where you basically keep cash, and it's to protect the lender, the broker, against price movements. And like you say, if the price moves too much, that lender or broker might require you to put more money in that account. We don't really do that with houses, but it absolutely does happen with things like stocks and futures. If the price goes down too much and now you're underwater, or not even underwater necessarily, just below what the margin call threshold is, they will require you to top up that account. And if you can't do it, then they are going to close out your position because the risk is now on them. They're making loans that you're not going to be able to pay back. So they don't want that. So if the value of your position goes too low, you're below the margin call threshold, then if you don't make that margin call in a certain amount of time, they close out your position. They sell the asset for you.
I believe this is what happened to the pension funds during Liz Truss's government and why they were going into a liquidity crisis. It wasn't because they had completely lost their positions, but it was because there were margin calls requirements that they were at danger of not being able to meet.
And then there's a similar thing there as well, in that the sell-off of the gilts, because the pension funds were trying to raise money to meet margin calls, and they were selling off gilts. And I can't remember whether it was the 5-year or the 10-year or both, but the sell-off caused the price to go down, right? It caused the yield to spike up because they run counter to each other, the price of yields. So when the yields are going up, that's also the benchmark that mortgage lenders use to price their mortgages off, right? So domestic mortgages, then all of a sudden mortgage rates start going through the roof. Am I right?
Well, I don't know what the transfer mechanisms for how banks decide their mortgages, but yeah, I guess it would be related. I was reading a quote by James Tobin, and it's sort of related to what you just said. And we were talking about how big should financial markets be. And I guess from my perspective, I have a bit of an issue with the size of the financial markets in the UK in particular, because I guess I worked as an engineer for a very long time. And I often see the engineering industry competing with the finance industry for skilled engineers. And it's a competition that the engineering industry just cannot win, right?
My undergraduate degree was in physics, and like a bunch of the people that I went to school with went into finance as well, like physics majors.
So every time that happens, it's a little sad in my head, because we have problems that engineers need to fix at the moment. And we need scientists and physicists everywhere, climate change, social challenges, all of that. So I found a quote by James Tobin on a paper that he wrote. It's called On the Efficiency of the Financial System, and it was published in 1984. And in it, he writes, "We are throwing more and more of our resources, including the cream of our youth, into financial activities remote from the production of goods and services, into activities that generate high private rewards disproportionate to their social productivity. I suspect that the immense power of the computer is being harnessed to this paper economy, not to do the same transactions more economically, but to balloon the quantity and variety of financial exchanges. For this reason, perhaps, high technology has so far yielded disappointed results in economy-wide productivity. I fear that, as Keynes saw even in his day, the advantages of the liquidity and negotiability of financial instruments come at the cost of facilitating nth-degree speculation, which is short-sighted and inefficient."
That is a perfect segue into the next film that we wanted to talk about, which is The Big Short from 2015, because that's all about how complicated and how exotic these financial instruments have gotten, as I understand it. And The Big Short is a film which a lot of people regard as quite a faithful depiction of the causes of the great financial crisis, because it's based on a New York Times bestseller called The Big Short: Inside the Doomsday Machine. That's written by an acclaimed financial journalist, Michael Lewis. Now, the book is about real people who saw the housing bubble and the subsequent crash coming. But in the film, apart from hedge fund manager Michael Burry, who's played by Christian Bale, all the other characters in the film are fictionalized representations of the real people covered in the book, with their names changed. So just wanted to flag that up. But anyway, the film does a great job of laying out this really complicated set of circumstances in a really entertaining way. So let's start by setting the scene. Now, Sam, sorry for this huge question, but how did the great financial crisis come about as you see it? Because in the film, I think they locate the seeds of the crisis in the invention of mortgage-backed securities sometime in the 70s. But you start anywhere and we'll take it from there.
Well, I guess it's one of those things where I don't want to say there's just one cause. There's many, many contributing factors. A lot of people point to the deregulation that began in the 1970s and continued into the 2000s, especially one people like to point to the Graham-Leach-Bliley Act that basically dismantled Glass-Steagall, which was the regime, the financial system regime created during the Great Depression, part of the New Deal.
That was on Clinton's watch as well, wasn't it?
Yes, it was. Another one was the Commodities Futures Modernization Act that basically stopped the government from regulating credit derivatives, the kind of instruments at the heart of the problem. I would also point to major waves of fraud. So one of my professors was Bill Black, who studies financial fraud. He's got a book that's called The Best Way to Rob a Bank is to Own One, which is about him being a regulator during the savings and loan crisis in the 70s and 80s. and how there was a wave of fraud, but that they cracked down and arrested tons of bankers and stuff like that. And meanwhile, in the 2000s, there was a similar wave of fraud that was spottable. They could have seen it and done something, but did not. And it just kept getting bigger and bigger. And then also they didn't arrest anybody afterwards either. So take that. The thing is that the great financial crisis is sort of bigger than just some financial problem or an individual bankruptcy or a particular fraud scheme or something. Like one of the movies that I watched was The Wolf of Wall Street, which is about this company in the 90s called Stratton Oakmont, and they have this whole fraud scheme and they go under and it's a big thing. But that wasn't like nearly on the scale of the great financial crisis. And that's because the great financial crisis was actually a failure of business models. It's like the whole ecosystem failed. Like not just this particular firm was up to no good, but entire business models, the way we thought that the financial system should work, proved to be wrong. It proved to be unworkable. And the contradictions just kind of like build up until you get this big crash and it all falls apart.
And how about you, Patricia? I mean, how do you see the timeline of the great financial crisis evolving?
I think Sam is right that there are many contributing factors. I mean, the regulation to some extent enabled the fraud as well. So they're linked. But one thing that maybe that I don't feel that is discussed enough is that I do feel that there was a political need for finance to become what it became during those 3 decades. And because if you think about it, we have a period of great austerity. And then the only reason why there was an apparent prosperity in the 90s was because of credit issuance. And if we had not had that sort of soft approach on finance, we would not have had perhaps that big expansion in credit. And then it wouldn't have been a period of prosperity. So it was a system that enabled the main kind of neoliberalism, say, to appear to be far more prosperous than it actually was. And when the whole thing collapsed, it was more than a failure, as Sam says, of some localized guys in Wall Street doing naughty things. It was more of a failure of the system as a whole. But I don't feel that's discussed enough.
I was just going to say, I think Warren Mosler has said in the past, all the big credit expansions of the last 3 or 4 decades have been stuff that on a look back would not have been allowed. Like, so you have the savings and loan, multiple frauds leading to a huge credit expansion. Obviously, they're not going to do that again. Then you have the dot-com bubble, people investing lots of money because they think that the Y2K bug is going to make planes fall out of the sky. So people spend loads of money on software that they don't need. And then you have this great financial crisis. And somewhere in between there, you have, I think it was in the dot-com bubble, I think even Greenspan himself said that market practitioners were indulging in irrational exuberance. So, yeah, like you say, they're selling the sizzle and not the steak is basically been the way that credit has expanded.
And Patricia, I think you're connecting it to like capital labor conflict. People talk to stagnant real wages and the crushing of unions and labor bargaining power. And then, well, how's your consumption going to go up? How are you going to keep up with the Joneses if you don't have rising wages? Well, credit, right? So there's that story. And then another story like relating to austerity, like you were talking about, is kind of the more MMT sectoral balance story, which is like, well, you have the government in the US at least, like tightening deficits, even running surpluses. And then right after that, you got the private sector going into deficit. And then right after that, we get a crisis, right? We have the private sector running a deficit right before the 2001 bubble collapses. We have the private sector running deficits in the mid 2000s, like unprecedented private sector deficits, right? So that's how the MMTers, I think, would chime in there too.
Yeah, I absolutely agree. And the fact that we didn't discuss it as being part of a more systematic failure like that, including all this conflict and broader economic issues, meant that as in the aftermath of the crisis, the solution to the crisis was part of what had caused it in the first place, which was the whole austerity thing. Oh, we can't afford this anymore. And it's amazing how it appears that we learn very little from the last 3 decades, and we just carry on doing the same. And everybody's puzzled as to why the economy is not growing as it should.
A part of that, I think, is pop culture, because if you want to sort of get your head around this stuff, you can read the financial press. You could maybe even do a PhD. But the way we feel about it as a culture is shaped by things like films and miniseries on Netflix and stuff like that. And often to tell a story, you've got to have a protagonist and an antagonist. And we're talking about systems, and they're very hard to anthropomorphize and make people feel emotions about, I think. And so that's why these films about the finance sector are not necessarily taking a swipe where we need it to take a swipe. Like I say, in Trading Places, it's about creating villains that you can knock down. Whereas we're talking about something that actually really does need dismantling. Unfortunately, it's not one of these top hat, mustache twizzling villains. It's a faceless system, almost like a belief system that needs to change.
We'll be right back after this message from our sponsor. Hey there, dear listener. Our sponsor for this episode of the MMT podcast is you, the listener, and we can't do it without you. And when I say it, I mean our aim to promote the best understanding that we can put together of how this thing called the economy actually works and how we can make it better. And we think a big part of that is knowing that better is possible, and that many destructive policy choices are often sold to us by falsely equating the spending capacity of a government to that of a household. The way your government spends is nothing like the way a person or a household spends, because currency issuing governments are the source of their own spending money. Unemployment, underemployment, underfunded public health services, poverty, and many other things that politicians and pundits sell to us as sad but necessary are actually never necessary. Our money system has been mischaracterized in the media and academia for decades. An electorate that knows how it works can truly change things for the better and literally save lives. So we hope you can find it in your heart to support us via patreon.com/MMT podcast, because it really helps keep the show going and we want to make it bigger and better. So thanks as ever for the time you put into understanding MMT. Let's dive back in.
I think a lot of these movies, what they do is, as you say, they identify the problems, but they don't blame them on the system. They blame them on bad capitalists. And then,
as long as we can just get the good capitalists in there, everything will be fine.
Exactly. Yeah.
And the thing is, like, I think it's a little bit of both, but there's kind of a feedback process. Like, when you hear some of the things, like if the movie Inside Job, which is like a documentary about the 2008 crisis, and Matt Damon narrates it, and one of the things that I laughed out loud at, I don't know how, but I never heard this before, the company AIG, which was this big, functionally, it's an insurance company. They're offering these credit derivatives that's basically like somebody owns a bond and it's insurance on that bond. If the person doesn't pay, the person that borrowed the money doesn't pay, then AIG will step in and pay for them. So it's kind of like insurance. And if you're running an insurance company, then you need to have money set aside so that when claims get filed, you can pay the claims.
You think that's the bare minimum, wouldn't you?
Yeah. So AIG had none. Just no loss reserves at all, right? And so there are people at this business that's not like, oh, we didn't realize, or like
they knew they'd be bailed out.
It's either they knew they'd be bailed out, or they knew that they personally were going to leave before the music stopped. But there's no way that you can look at that somebody at that company looks at that and goes, okay, we have all this exposure, we have no loss reserves. That is a disaster waiting to happen, and they didn't have to make that choice. Right? If there were people there who cared about the long-term future of that company, cared about their clients, cared about the success of the economy and systemic risk, they could have set aside loss reserves. Yes, they would have made less money personally, but, all these other concerns, right? And so to me, it's a combination of the system is bad. It creates these terrible incentives, and then also selects for bad people. It systematically puts the worst people it can find in charge of making the decisions. And so there's truth there. There are these terrible people running the show. And if we had better people, it might turn out a little bit better. The problem, though, of course, is the selection mechanism. We could put better people in there, and then 10 years later, they'd be gone, and the bad people would be back running it again. So we need to tackle that, too. But all I'm saying is, like, there is, I think, a little bit of both here. Like, just because it was a systemic problem doesn't mean we shouldn't have arrested all of these people that were committing these fraud schemes.
Oh, yeah, no. I bring the systemic thing up not to let those people off the hook, but just to say that if it's systemic, it means it doesn't matter who you slot into this position, they're going to have to act in this way. I think that's a problem.
If the system says people have to be uncaring and greedy to be successful, then those who will do well will be those who behave in an uncaring and greedy way.
Back to Milton Friedman, the only social responsibility you've got as the person running this company is to make sure this company maximizes shareholder value.
Yeah. And back to Trading Places, like that movie is all about kind of nature versus nurture. And it comes down very hard on the side of nurture. You get Winthrop, who's this respectable guy who turns into a criminal. And you get Valentine, who is this criminal who turns into this respectable guy. So there's some of that too, right? It's like, not only does the system find bad people and put them in charge, it also turns good people into bad people.
Yeah, and I get what you're saying, Sam, but also there's that question lingering over Trading Places of like, hang on, was the criminal at the beginning a criminal? And was the respectable person the yacht-sipping people at the end that they ended up being? Is that really respectable? Obviously, as the audience, we're rooting for them. We want them to do well.
We'll be right back after this message from our sponsor. Hey there, dear listener. Our sponsor for this episode of the MMT podcast is you, the listener. And we can't do it without you. And when I say it, I mean our aim to promote the best understanding that we can put together of how this thing called the economy actually works and how we can make it better. And we think a big part of that is knowing that better is possible and that many destructive policy choices are often sold to us by falsely equating the spending capacity of a government to that of a household. The way your government spends is nothing like the way a person or a household spends, because currency issuing governments are the source of their own spending money. Unemployment, underemployment, underfunded public health services, poverty, and many other things that politicians and pundits sell to us as sad but necessary are actually never necessary. Our money system has been mischaracterized in the media and academia for decades. An electorate that knows how it works can truly change things for the better and literally save lives. So we hope you can find it in your heart to support us via patreon.com/MMT podcast, because it really helps keep the show going and we want to make it bigger and better. So thanks as ever for the time you put into understanding MMT. Let's dive back in.
If I can have a quick aside here, one thing that is a very sharp contrast between Trading Places and The Big Short, or really any of the later finance movies, Wolf of Wall Street, is that the traders behave themselves very differently. Maybe traders is maybe too specific. Just the financial types in these movies. Like in Trading Places, it's very much like an old money kind of club. They go to the country club and they're playing tennis, and the barbershop quartet from Harvard is like singing whatever Harvard songs. It's all very ceremonial. There's a lot of decorum. The butler stands here and says this and hands you that at the right time. So it's very choreographed. It's got this old money kind of vibe to it. And then compare that to Boiler Room. You can compare that to Big Short. You can compare it to The Wolf of Wall Street. It's much more just kind of debauchery, right? Like sex and drugs all over the place. There's very little, like the respectability part is like a veneer on top, like they wear suits to work or something. But otherwise, they have no pretense of like, we are respectable people that are shepherding our institutions. Like, that's just gone. That's like, by 2 decades later, it's like, we're in it for the money and we're going to get hookers and blow. And that's our deal.
I think part of that is that this sort of common folk tale that sprung up in the 80s, it probably sprung up in the States, and it definitely sprang up in Britain, which is that actually what's happening now, this embrace of neoliberalism and this sort of dumping on working people and strike breaking, and we actually set the police on our unions because they were striking over here. Thatcher did anyway. But the story was, no. The people that are embracing neoliberalism and he who screws over laughs longest, that whole embrace was depicted as, no, that's good because working class people are now getting in on the act. It was once this reserve of Ivy League people and Oxbridge people, and now working class people are getting in on the act. And the way they depict that is, these people who have come from nothing go in and make a ton of money and they go crazy. I think that's really the story they're trying to tell there.
I think there's also an element that's like in the basic, just the very basic story from Econ 101 or from mainstream economics is like competition is good. Competition is good for society. So let's make the world more cutthroat, more competitive, more dog eat dog, and that will benefit us all somehow. Maybe there's a few situations or frictions or whatever where it doesn't, blah, blah, blah. But for the most part, greed is good, competition is good. These are themes that come out of the Milton Friedman version of economics, and they become embodied into our institutions.
Can I ask you both a question? How do you think masculinity is portrayed in these movies? Because I think it's quite fair to say that finance is a very male-dominated field. And in these movies, it is a very male-dominated environment.
Yeah, like I said at the beginning, the life seems to consist of wearing a suit, walking around yelling at people and yelling your opinions into people's faces. I mean, this is like what being a man is all about as it's sold to us, I think. I should have added being male to that list of characteristics.
Yeah, so do you think that the values that are promoted in the finance sector are pretty much the same values that are promoted to men in general?
I don't know. In the films, I'm thinking, obviously, like all films, and this is only just starting to change, that there aren't many roles for women in the films. They're ornamental and, it's absolutely sexist, for sure.
In Trading Places, the scene where Jamie Lee Curtis gives her money to Winthorpe and Valentine, she says, like, I hope you know what you're doing. And then she says, like, what are you doing? Like, tell me what you're doing. Like, she doesn't understand it and they won't explain it to her. They just walk away. It clearly can't be because she's a novice to finance, because so is Valentine, right? He's been doing this like one day or something, or a month maybe. And he has a very clear idea of what's going on. And it's like, we can't explain this to you, Jamie Lee Curtis, but this other guy, the man, he got it. So I think there's some of that. In the movie Boiler Room, which is a movie about like a bunch of traders on a trade floor, and they're like aggressively selling stocks. They like call people up and try and sell stocks to people. And they're mostly like bad deals. They're sales guys. They like call and really like make this aggressive sales pitch. They're selling crap. One of the things that the trader says when he's training a new guy, he says, we don't pitch the bitch. And what he means by that is we do not call women. If you get a woman on the phone, hang up, because we do not want a woman as a customer, because they're going to call us back and be checking in on the stock every 15 minutes and getting up in our hair and freak out about, the price went down a little bit.
Just generally acting like a rational human being and going, what are you doing with my money? We don't want to talk to people who are going to ask those kind of questions.
I mean, these movies are not flattering to men, are they?
Oh, absolutely. And I think that's probably fair to not flatter the men, right?
Yeah, there's a scene in Boiler Room where one of the traders just starts a fight with a guy at a bar for no reason other than that he's bored and wants to fight.
He's kind of the sort of, if you've seen Goodfellas, the Joe Pesci character in Goodfellas, who's like a live wire. He can go from like laughing with utter glee 1 minute to shooting somebody dead in a split second. And I think they're trying to set that character up in Boiler Room like that. He's just somebody that will just sort of like, you look at him the wrong way, he'll kick off.
And my professor, Bill Black, has got a paper that's kind of on this topic, which is like, how these fraud schemes actually, it helps the fraud scheme if you can get a really toxic culture in the business place. If you can get a really toxic culture of the workers competing against each other, really cutthroat, racism, sexism, like whatever else, that actually improves the fraud scheme, because now you have your workers that are like just not really thinking of people as people, that are thinking of them as marks to be taken advantage of. And how can I take advantage of a woman better? How can I take advantage of Black people or whatever it is? Then they supercharge your fraud scheme. So they are connected, right? And so you can talk about like this movie is not a very kind portrayal of this kind of masculinity. But you can also talk about how these kinds of schemes, they need that kind of culture. And so they create it and they select for it. So even like regardless of whether you want to like try and draw a generalization to the broader population, you still need that kind of thing to get away with this fraud scheme. It helps.
Right. And in fact, in Boiler Room, they sort of go into the life of somebody, of one of the marks, basically, one of the people that gets sold some stock that's kind of junk. And one of the selling technique that the protagonist uses is to sort of say, look, you don't need to ask your wife, because he basically, when he's being pitched, he says, okay, well, let's talk tomorrow after I've slept on it and talked to my wife. You don't need to talk to her. You know, be a man, stand up for yourself. Are you a man or a mouse, basically?
I wonder if you agree with me, but in Wolf of Wall Street particularly, I mean, the movie is not flattering to the main character, right? He does drugs, he treats other people very badly, and he treats women very badly. He cheats on his wife, etc., and he commits fraud. But there is this duality in the movie, whereas on one side, they're saying, oh yeah, look, what an asshole he is, forgive the word. And then on the other side is also saying, but isn't it cool? Wouldn't you want his lifestyle, to have a wife like that, to be able to have this many women, etc.? And it's like it critiques it, but at the same time it presents it as aspirational.
Yeah, I think with Wolf of Wall Street, above anything else, before it's a film about finance or anything like that, it's a Scorsese film, right? He gives it the Scorsese treatment. He manages to pull off that thing of making some really despicable, base people absolute heroes, right?
And, I think like what I took away as the lesson was, even if this lifestyle is cool, I guess, for lack of a better term, like the costs are too high. Leo DiCaprio's character, Jordan Belfort, who's based on a real guy.
He was in the movie as well, right?
Yeah, he supposedly has a cameo as an extra or something towards the end, I think. But he comes to the realization that this is too much, like it's gone too far. I think what happens is, spoiler alert, his yacht sinks because he's like racing back to try to launder money. And so they go through like choppy seas that they knew they shouldn't have gone through. His yacht sinks, and then he sends for a plane to rescue them. And like the plane crashes and a few people die, and he like is the only one who even sees it. And he's like, I knew at that moment that this had gone way, way too far, and I had to stop. Like the costs were just piling up and were much too much.
But, that's the sort of magic trick that Hollywood pulls off. If you look at The Big Short, right, it's basically 3 stories of people who all saw the same thing, the subprime bubble, and they figured out how to make money when it burst. And here's where you've got to take your hat off to them, because it's hard to make profiting from human suffering into an act of heroism. But in The Big Short, which is supposedly quite faithful to what actually happened, for instance, the Steve Carell character is just disgusted with the establishment all the way through the film. And yet, if the establishment don't carry on being disgusting, he's going to lose all his money and then his investors' money. So he's dependent on this disgusting behavior. And I was thinking about it. I was thinking, it's like being a shareholder in a company that makes snuff films and saying, oh, I hate these films. Well, people should really stop making them, and then counting your money. It's ridiculous.
I got to say, this is an underrated selling point for the job guarantee, by the way. Like, I'm serious about this. Maybe it wouldn't have applied that well to the character Mark Baum, but one of the things that I think our society is really struggling with right now is we are like rebuilding some moral codes of conduct and saying like this behavior that used to be acceptable is no longer acceptable anymore. But we don't yet really have routes to forgiveness, like safety nets. And in a weird way, the job guarantee plays that role to some extent. And maybe it's more obvious with employment. It's like, if you lose your job right now, the consequences can be like, maybe when the economy is not doing as well as it is at the moment, but for the last couple decades, the consequences are so bad and they can last such a long time and be so damaging that just gives people tons of incentive to take everything way too far, to cling to what they have, to destroy other people's livelihoods if they need to. And so we need a kind of comprehensive system, of which the job guarantee is one part, of like re-entry, of getting people back into society so that they can leave positions that aren't working or are antisocial or whatever, and find something else to do and have it not be so disruptive and costly, right? It's like, if people don't have jobs they can turn to as alternatives, then they're going to take advantage of other people if they have to keep their job. Whereas if you have a job guarantee, a safety net of some kind, and, these other kinds of cultural safety nets too, then, they can say like, this is bad, I'm getting out. I don't need to be here. I can do this other thing and it'll knock me down a few pegs, but I'll be able to work my way back up. I don't need to push this as far as it goes. People get into this like, I'm in too deep, I can't stop kind of situations. And that happens because there's nothing for them to turn to. So we need to have systematically ways, like things that people can turn to both economically and in other facets of life.
And we should always underline, and sorry to the listeners who've heard me say this loads of times, that, far from having something that you can always turn to, we have something that you can always expect, which is unemployment. That's built into the system the way we do it now. Let's say the economy is the best it's ever been under monetary policy, which means, I don't know, maybe they get it down to 3% unemployment. That's still millions of people who want a job, who can't get a job, deliberately being kept out of the workforce because of monetary policy. So I think we need to never miss an opportunity to say that, look, in case you were thinking about blaming people's unemployment on themselves, or a lack of guile or something like that, it's actually built into the system. If these people were like brain of Britain, we'd have to still push them out of the workforce because we need to, quote unquote, soften the labor market under the way we run it now.
And Mark Baum, the Steve Carell character in The Big Short, he says, like, this is a system problem. The whole system is rotten. But I think what's going to happen is people are going to blame poor people and immigrants. They're not going to blame the wealthy people or the system that's really created this problem.
Let's just inject a bit of technical stuff here for those that are interested, because it gets talked about and unpacked quite well in The Big Short. But to understand the great financial crisis, they do a good job of getting you to get your head around some of the exotic financial instruments and the terminology. So what is a mortgage-backed security?
Okay, so a mortgage-backed security is kind of like a bond, right? A company might sell bonds, which is some form of them borrowing money and promising to repay in the future with interest or whatever. Except instead of it just being a general obligation of the company where the company says we need money to do this or that, we're going to sell a bond. These bonds are backed by mortgages. So you actually create a business entity that's like its own legal unit. And what that legal unit does is it sells bonds, raises money, and then uses that to buy loans or make loans that are mortgages. There's other kinds of debt too. You talk about like asset-backed securities and things like that. But anyway, and so the goal of this thing is to allow investors to be exposed to the real estate market, which would not be possible if people were just borrowing from banks and the bank was just holding the loan. So like in the, let's say, pre-1970s vision of finance is kind of, people like to call it the Jimmy Stewart version of finance, which is like from the movie It's a Wonderful Life. It's a savings and loan, and they make loans out into the community, and then they hold the loan. So you make a 30-year mortgage, and the bank now, you're repaying the bank for 30 years. This is just an asset for the bank. Well, okay, there's some problems with that. One is that, well, what if the bank is overexposed to this area maybe? Like, if a bank is just making mortgages and holding them, then the bank's risk exposure is very geographically correlated. So it's like maybe there's a tornado that knocks out the city, and it's not just going to do all its damage, and it's going to also cause financial problems for individual people, but the bank might go under too, because all the bank's assets are mortgages in this area. And now, you know what? Now these mortgages, some of them can't be repaid, or they're worth less than they were before, or whatever. And so the banks want to diversify. They don't want to have all this kind of correlated risk, maybe. Meanwhile, for investors, if the bank is just making a loan, what if an investor would like to own some share of the real estate market? You have investors who are thinking like, what's going to go up? What's going to go down? Maybe some stock's going to go up. Maybe real estate's going to go up. And I would like to go long on real estate. I'd like to own a piece of the real estate market. So we have some vehicles for that, but they're maybe not as efficient as this one. So basically, the legal entity here holds a whole bunch of mortgages. As payments on those mortgages come in, they turn around and make payments to the bondholders, to the investors. And that's a mortgage-backed security.
And the idea is that the genesis of the housing bubble in the States was subprime mortgages. And I believe that your Professor Bill Black had a lot to say about that as well. And the idea is that they went from like low doc loans, which means, okay, you don't have quite as good credit as the next person who's got a steady job or can show their credit worthiness in that way. Then it was no doc mortgages where you don't even have to prove that you've got a job or any income. And I believe they were called ninja loans, no income, no job, no problem, right? And so people were buying houses who didn't have any credit worthiness.
Yeah, so this is the term used within the industry, not even outside the industry. They're called liar's loans. And the banks knew about this. It's like, we're making liar's loans. So sometimes it's just like no reporting, like, hey, you don't need to tell us this. Other times it's like, you can tell us whatever you want, wink, wink, nudge, nudge. Like, just write a number on this line for what your incomes are, and we're not going to verify that.
Just want to jump in here and say, yeah, let's emphasize that it's called liar's loans. They're called liar's loans because what I take from that is that the institutions extending the loans were doing fraud, right? Because people go, oh, well, there were these people who were lying to the banks about being able to pay them back, and they're the fraudsters. But it makes me think of Michael Hudson's quote, a loan that can't be paid won't be paid. And so the institutions themselves are extending these kind of loans that they know won't be paid. So they're doing fraud as well.
Yeah. So Bill Black likes to talk about control fraud. And so by control fraud, we're talking about the CEO or the executives at the company using their power over the company to basically loot the firm, to extract assets from the bank or from the whatever the financial company is. And part of the way that you do this is you make the profits on paper look as large as you possibly can. And then earlier we talked about modern executive compensation, right? The profits on paper look really good. The stock price is going to go up. The executives are going to get paid more, or they'll be able to take larger bonuses. And so it would be funny if you didn't have to cry about it, that Milton Friedman comes in and says, the shareholder primacy, modern executive compensation, that's all we need to do. And that gets so perversely distorted. Today, we're like, this was obviously a gigantic mistake. It incentivizes the managers to create fake short-term profits as much as they can. So part of the way you do this as a bank is you make loans to people who are not going to repay them, people who you know cannot repay them. And why would you do that? Well, if you were an honest bank, an honest lender, you would never want to do something like that. But if your only goal is to make your short-term profits figure in the accounting look as high as possible, then it's great because number one, you get the fees, right? The origination fees. You're making a loan and sure, they're not going to repay it. In fact, they might not even have the money to pay the origination fee. You might lend them the money to pay the origination fee, okay? But you've now booked a fee. You've booked it as income. It adds to your profits. Also, people who are the subprime mortgages, people who are not as good of a credit risk, low credit scores or no credit score, or if they've been in bankruptcy or something like that, right? Well, the formulas that dictate what the mortgage rates can be allow you to charge a higher interest rate to these people. And so you charge a higher interest rate, and this is part of your fake profits, right? So yes, the incentives here are for the bank, that is the CEOs that are committing these fraud schemes, to make as many loans as possible to people who cannot repay them. You're trying to grow the bank as fast as you can to inflate the profits numbers so that you can then pay this money to yourself in the form of bonuses or stock options that you cash out in or whatever. You're looting the bank because none of this is actually generating any real value, right? You make a loan to somebody you can't repay. There's no actual value creation happening there. All you're doing is when the CEO pays himself, they're just stealing from the bank.
But this is happening as well within a context of house prices having increased for some time and people thinking that it was just going to carry on. And I think people at the bottom who were actually purchasing the houses were kind of reassured by the notion that, well, house prices can't go down. So, I should get in here as quickly as I can. But also the people who may have taken those risks, the mortgage-backed securities and all the stuff, it was perceived as a safe bet all around because of those house prices increasing. And I feel that what you're describing, Sam, sort of perpetuates that cycle for as long as possible, I guess, until it all implodes.
Yeah, Bill Black likes to use the phrase hyperinflate the bubble. But yeah, you're getting people to buy houses who otherwise wouldn't be able to. And housing is a market that very much is credit constrained. This might not be true for a lot of other markets, but in housing, if more loans become available, more people buy houses and demand goes up and prices go up. Especially in the US, we have a very supply constrained housing sector. So prices tend to go up rather than a lot of new homes getting built.
And this is kind of back to the Duke brothers, where people are looking at this trend of prices going up and they all want in on it. So the bandwagon effect happens to the home buyer. at the ground level and then also to the mortgage-backed security trader at the next level, right?
Yeah. And you also have people who didn't realize what they were getting into in some cases. Like there were adjustable rate mortgages with a teaser rate. So it's like you might have a low interest rate for 1 year, 3 years or something. And then after that, your interest rate's going to jump up to whatever the market interest rate is going to be in. And that wasn't always explained to people. And you have, if I'm not mistaken, in The Big Short, the scene where Steve Carell is talking to the stripper and the stripper is saying like, oh, I don't pay very much on these and I can always refinance. And Steve Carell says like, that's just your teaser rate. You know, the rate's going to bump up. And she says like, she didn't know that. And she says like, on all 5 of my houses. And so people got sucked into things they didn't understand. Kind of like in Boiler Room, there's really high pressure sales tactics. It's like really, really trying to get people to take out loans, even if they don't understand, even if they can't repay. In some cases, just making it up. Sometimes there would be, I talked before about how sometimes the banks would make clear to the borrowers that they were not going to verify what their income was. Other times the banks would just forge the income. It's like you wrote some number in a back room somewhere, they scribbled it out and write a bigger number. And now you qualify for the loan. And they didn't tell you that they forged your signature on these documents or whatever. There was one case that I saw on The Daily Show a few years after the crisis where a bank tried to foreclose on somebody who didn't even have a mortgage with them. That episode was really funny. I mean, the bank tries to foreclose on this guy and then he forecloses on the bank. Like he gets the sheriff, small town sheriff or whatever to show up at the bank and they take the bank. I don't know how that ended, but that is not an option available to most people.
So the whole thing, I mean, we have spoken about all the causes, but then the trigger was the US government raising interest rates. To what extent would this bubble would just have continued for many, many years had that not happened?
I don't quite remember the exact timing here. The housing prices like peaked and started to fall. And I want to say that was like 2006 and 2007. And I don't remember exactly when the Fed was raising rates. So I'm not 100% confident to say like the Fed was the trigger here, but these things do run out of steam. I mean, what happens is by the end of this, they're just scraping the bottom of the barrel for borrowers, people who in no universe would be creditworthy, maybe didn't even make a single payment on the loan. And the way they have to find these people is like these really, really aggressive tactics. And I seem to recall that, I'm going to mess up these numbers, but it's something like mortgage fraud, housing fraud complaints to the FBI rose by a factor of 10 or something from 2001 to 2005, and then doubled again from 2005 to 2006, like somewhere in that neighborhood. So anyway, all I'm trying to say is the bubble was running out of steam. And I'm not sure if the Fed killed it or not, but it couldn't have gone on much longer because there's only so many borrowers. And the whole thing is a big Ponzi scheme. And Ponzi schemes require new people to come in to pay out the old people.
So getting into The Big Short, basically we've got these financial products called mortgage-backed securities that are going to crash in value. And a small number of people see it. And the reason it's called The Big Short is they find a way to profit from the bubble bursting. Can you talk about that, Sam?
Yeah. So, I mean, the story kind of revolves around this set of characters who all realize they want to go short the housing market or mortgage-backed securities specifically. It's a mortgage-backed security. So it's got a whole bunch of mortgages, hundreds or thousands of mortgages. And for each one of those, if you can get a hold of the documentation, you go out and you look like, who is this guy? What's their situation? Are they making the payments on their mortgages? What's their credit score? What's their interest rate? And so on and so on. What's their debt to income ratio maybe? And they go out and look and they say like, this is a disaster. None of these loans are going to get repaid. You know, they shouldn't have been made in the first place. And this is a ticking time bomb. And so they say, how can we make money from this? We got to find a way to short these things. And so for some financial instruments, it's all very standardized. Like I was talking before about if you want to short stocks, you as a retail trader, just on some brokerage or, what Robinhood or whatever, you can just check the box and now you're short the stock. For other instruments, it's not like that. A big important part of the difference is between like an exchange, a standardized exchange where there's standardized products and there's a certain price mechanism where it's got defined rules versus what's called the over-the-counter market, which is where you have to find somebody to take the other side of this trade and you negotiate with them and you come up with a contract and then, there's your deal. And so we see in The Big Short, like Michael Burry goes to all the big banks, but he goes to Goldman and whoever else and says to them, I want to be short these mortgage-backed securities, create an instrument for me whereby this will happen, right? Whereby I will make money if the value of these things go down. And the people he's talking to are just incredulous. They're like, housing never goes down. You're just giving us your money. There's no way you're going to win on this positions. And he's like, just do it. And they're like, okay, we'll give you as much of this as you want.
You know, that again, that's the sort of magic of Hollywood again, because the antagonists in the film, the bad guys, are these people who don't see the bubble. And somehow through movie magic, they're made out to be even worse than the people who see the bubble, know it's going to harm millions of people and react by wanting to make money from it. You know, I think that's what I've heard screenwriters describe as making the bad guy badder.
Well, I don't know. If you think that the housing market is going to collapse in a few years, what do you do with that information? I mean, do you go on the news? I will say it's a little bit different now. And I was having a conversation with my propane trader friend. At this time in the 2000s, if you said the housing market was going to collapse, nobody believed you. Like, they depict that in this film, and I think that was real. People had a lot more faith in the system back then. There was a long track record or whatever. And you guys are familiar with these terms, bulls and bears. The bulls are people who think the market's going to go up. The bears are people who think the market's going to go down. So the bears are kind of like the doomsayers. And back then, you couldn't be a bear. Everyone was a bull. And if you were a bear, you're like an oddball out. You're an outcast or something. Today, it's not like that. Today, there's plenty of bears. And I'm not sure if that's just because everyone's just way more depressed or whatever. Or maybe it's because people got burned by these crises. And now it's like respectable to say maybe there's another crisis coming. But anyway, you're a Cassandra. Like, who's going to listen to you? And what are they going to do? And I think the Mark Baum, Steve Carell character struggles with this of like, is it okay for me to make money off this? And he kind of decides like, this is sticking it to the system, sticking it to the bad guys who have been profiting from hurting the little people. So he kind of comes to terms with it. But yeah, I don't know. What do you do? What do you think's the moral thing to do there?
Christian Bale's character sort of does something like that, where he goes to Goldman Sachs and he shorts all the mortgage-backed securities and they laugh at him.
Yeah, I'm saying that that's the way they make those guys out to be the bad guys, by sort of like just, oh, look how arrogant and uninterested in the real world these people are. And therefore, yeah, Christian Bale's character is called Michael Burry. That's actually the real name of the guy who did it.
I think the bit that really did it for me was when it was obvious that the whole thing was imploding, and then Christian Bale character, what's his name again?
Michael Burry.
So he's wondering why his money isn't coming through and why the mortgage-backed securities seem to be going up in price rather than down. And then he realizes that actually the people are fixing this whole thing by basically offloading all their exposure before they let the market collapse in a way.
Yeah, the banks themselves, Goldman Sachs, for instance, right?
Yeah. So that's highly immoral.
Yeah, and he's right. I mean, it's market manipulation, and that's possible in these over-the-counter markets that are very individualized, relationship-based, and especially these really opaque financial instruments like mortgage-backed securities or collateralized debt obligations or credit default swaps or whatever. These things are really hard to price. Like we have in an intro finance class, you would learn what is the way to price a bond, like just a simple bond, corporate bond or treasury bond or something. What is the fair price of that instrument based on its financial characteristics? And there's a little formula, mathematical formula, and it's pretty straightforward because we understand how they work and they're very clear and they're predictable. But mortgage-backed securities, just housing in general, is not like that. And there's a variety of reasons. One is that prepayment is a big thing. So like in the US, we have this whole like 30-year fixed rate mortgage system that allows you to just repay your mortgage at any time with no problem most of the time. And people use this to refinance. If interest rates go down a whole bunch, I could borrow at a lower rate. I'm going to take out a new loan, repay the old loan, and now I'm borrowing at a lower interest rate. So people do that, and it's good for homeowners. But on the other side of that, the investors and the servicers have to deal with like these things are hard to predict. We could just have a flood of money coming in and repaying all the loans at any time. It's not like a bond where there's cash flows on specific days. So they're very, very hard to price. And the way they get priced is the system called mark to model, which is you have a very complicated mathematical computer model that takes in all these different factors and spits out like, well, here's what the price should be. And different banks might have different models telling them what the price should be. And so now you've got no clear answer with what the price should be in the way that there kind of is with a corporate bond or something. And so that creates room for, in these small individualized relationships and contracts and stuff, to lie or to make things up, or for the prices to be decorrelated or go in different directions or whatever. So they're very opaque markets.
Yeah, it seems to me whenever I look at films or documentaries about the global financial crisis, like you said, Sam, you just said, what are you going to do if you see a bubble like that coming and you're certain about it, or as certain as you can be about anything? So the traders are just trading the market. So perhaps they're blameless. There could be an argument there. But to me, the definite culprits are the lenders making the subprime loans, then the ratings agencies who rated the products derived from those subprime loans as safe. And then perhaps the most villainous of all are the investment banks who, as Patricia was saying, were selling these derivatives which they knew were going to crash in value. And we know they knew because they themselves bet against them by shorting them themselves. In sort of like in the sort of taxonomy of sins here, I think the real bad guys were the people who were talking out of both sides of their mouth the most were, let's say, Goldman Sachs.
Like another, back to Protestant values, another issue is like, who is the sinner? Is it the person who is being tempted and succumbing to temptation, or is it the person who is doing the tempting? Like, who's worse, right? Like, because when you have these perverse incentives, right, you're tempting people. You're saying you can make a lot of money if you commit fraud. You can make a lot of money if you hurt people. You're not going to get caught. You're going to be rich, right? Like, there's a big temptation there. And so when people succumb to that temptation, they're committing a sin. But it really was a whole broken system that attracted and created bad people.
But, you know, what's good, what's bad in a world where the social responsibility of a firm is to generate shareholder value? All you've got to do is believe that one tenet and you're in the clear.
The system has to penalize bad actors, right? We have to have individual responsibility that it comes in at system level by saying that the system has to penalize bad actors. But how fair is it to penalize bad actors when the system is also encouraging you to behave badly?
Well, I'd go further than that and say that we're moving towards what it's like in the US, Sam, over here in Britain. This is what I think anyway, that it's been a drumbeat for a long time, at least a decade. Maybe it's been 3 decades of media commentary saying basically there's never going to be a state pension for you people. If you're a young person now, by the time you get to pensionable age, it's not going to be one because the government's going to go bankrupt. So there's not going to be a state pension. And also they're going to run out of money for the NHS. So the state is not going to look after you. Okay. Now, in a world where you're told that every day in loads of different ways, sometimes it's in a sitcom, sometimes it's actually in the business press, and sometimes it's on the front page of the newspaper. You know, NHS is in crisis. The government's going to run out of money. In that context, you cannot possibly save up enough money to cover you when you get ill. And well, there's one certainty in life is that, you know, you're going to die and you're going to get pretty flipping ill just before that happens. And it might be for years before that happens. How can you possibly save up enough money to cover that? So even people that believe, oh, you're only worth what you can actually make, you know, what you can actually sell your labor, your time for on the open market, even for those people playing by those rules, you cannot possibly save up enough money for old age or infirmity. And in that context, I would say that puts us all in a post-greed era. You cannot possibly be this thing called greedy because there is no amount that is too much to have in the bank, given these circumstances that we told we're going to face inevitably in the future.
It sounds like we're going to be doing podcasts up until we're 90. Christian.
No, but you see what I mean? I'm saying, like, as long as you believe these things, you are not entitled to dignity in old age. And there's certainly, whether you are entitled to it or not, the government's going to run out of money, so you will not have it. Then you are completely susceptible to this idea that actually there's no such thing as greed. You know, you cannot have enough money stuffed in your mattress.
It's a survival thing. It becomes a survival thing.
And I say this as a left-wing person who doesn't want it to be that way, who is doing this podcast as a way to say, look, this is where money actually comes from, and it's a policy tool for moving resources around, and we should absolutely be moving resources around to comfort the afflicted, and God forbid, afflict the comforted. I think it goes a long way to explaining our national psyche right now is like, what's greedy in a world where you can't possibly have enough money? Literally, you can't have enough money.
In the topic of individual versus social responsibility, I feel like we've been discussing a lot as to, where's the line drawn here and how do we do both? Because there's got to be some of both. But the truth is that to change the whole system, we need some sort of social consensus, or we need to bring enough people to see an alternative in order to change things. And I don't really know how we do that if we put too much emphasis on the individual responsibility, because we risk alienating people, I guess, or we risk dividing people when we actually need them to get together.
I think if I were a psychiatrist, I would diagnose our national psyches as something really pathological. To me, what you're saying about individual responsibility as alienating people, I think that's only true in a world where there is no, I was talking earlier about forgiveness and reentry. It's if we tell people, here's our expectations, you do this, this, and this, you don't do this, this, and this. And if you mess up, here's how you redeem yourself. Here's how you get back into society's good graces. That's very clear, and it's hopefully easy to follow and doesn't create these pressures whereby people feel like they have no choice and they have no way to be on the up and up. Like I was saying earlier, they're in too deep and they have to double down on whatever they're doing. And so to me, there's nothing alienating about individual responsibility. It's just a model of individual responsibility that's punishment only and no redemption and no praise and none of the good parts of it.
But that's sadly the system that we have right now, right? If somebody commits a crime, gets into jail or gets some sort of criminal record, then that's it. You're marked for life for the most part. And it takes a very long time to sort of be reaccepted into the workforce as a regular human being. And so for some people to get out of that cycle is quite difficult. So it feels at the moment that it's like that one strike and you're out.
Yeah, I totally agree with you. And I think our system right now operates under the principle that there's a certain class of people who are always on the edge and we can't really trust them. And once they take 1 inch over the line, then that's it. That's their strike. We couldn't trust these people to begin with. And we got to lock them up, or we got to get them out of public life, or, whatever bad stuff happens to them doesn't really matter. And that is a long-term formula for a disaster, for alienating people, for creating an underclass, for creating subcultures that don't care whether or not we have national success or unity or trust or anything like that. I really do think you see this to some extent in the United States with the Trump movement, is that's kind of what those people are thinking. And it would be a lot better if the system operated under the assumption that mostly people are pretty trustworthy. And it's not the case that everyone's trustworthy all the time. We do need to keep an eye on things, and we do need to have discipline, and we do need to have accountability and mechanisms and stuff. But by and large, if we assume that people are trying to do the right thing until proven otherwise, then, we'd be on a lot better footing. And we'd have an attitude that's more like, okay, you stepped over the line, but let's help you back. Let's help you get back in the right place where you need to be, because we still need you. You can still do a lot for us.
That's a great place to leave it. We've been talking to Sam Levey. I'll link to where you can stay current with Sam in the show notes for this episode. But for now, thanks so much for joining us today on the MMT podcast, Dr. Sam Levey.
Thank you so much for having me.
That was the MMT podcast with Patricia Pino and Christian Riley. Don't forget, you can support the show through Patreon, starting at $1 a month, and get access to patron-only episodes. You can do that by going to patreon.com/MMT podcast. You can also find me on Twitter at MMT podcast, and you can find Patricia on Twitter at Patricia N. Pino, and you can email us at mmtpodcast@outlook.com. Thanks for listening, and we hope to hear from you.